Marty Mazur, good afternoon, 9th of February 2017. This week I'm just going to run through this week's client presentation. Every Monday I put together a group of slides for clients who come in for reviews, for the ones who like to really get into the weeds a bit and look at our indicators as it relate to economies and markets and so forth. So today I thought I'd just run through the slides and give you some commentary. The one in front of you is the ratio analysis per sector. And S&P. The top one is the technology index. That's okay. We have a lot of that in our clients' portfolios. In fact, we use most of these ETFs actually as investments. So this tells us how well the index, and let's just say the sector, is doing up against the S&P 500 so far this year. I put a little green mark where it's outperforming, a red mark where it isn't. Technology is outperforming so far. Financials are underperforming. Consumer discretionary outperforming. Materials outperforming, energy underperforming, commodities outperforming, industrials underperforming, staples underperforming, utilities underperforming, and healthcare outperforming. Now that is somewhat of a mixed picture. When we look at technology, consumer discretionary, materials, and commodities, when they're beating the market, that says good things about risk, says good things about the cyclical sectors, suggests maybe there's some inflation coming in a good way, perhaps getting us into the mid to later stage of the cycle that can be pretty robust. But when we don't see confirmation from financials, you've got to wonder. Now I'm going to show you the financials chart here in a minute, and you'll get a feel for why maybe it's underperforming a bit so far this year. Energy, all over the place, finished the year real strong last year, should do well at this stage of the cycle. Industrials should do well in a year where we're supposed to get some infrastructure going, and in the later stage of the cycle as well. And I'll show you the industrials chart and you'll get a feel for why maybe it's not quite outperforming so far this year. Healthcare coming to life is okay. I generally view healthcare as a defensive sector, so that kind of conflicts with the idea that maybe we're in a robust stage of growth. But these defensive sectors, this doesn't mean necessarily that they're losing money, but it does mean that they are underperforming. Okay, so moving forward, let's look at the actual chart for the technology index. The green line is the 50-day moving average, the blue line is the 200. When they're both sloping up, and particularly when the price is above those, that says very good things about the sustainability of the trend as we see it today. So a good looking chart for technology. Financials, look at the huge unsustainable spike from the election to the end of the year. What this looks like to me is very much a consolidation phase. We've got a slight underperformance relative to the broad market, but you cannot sustain that kind of move without some consolidation. My best guess is this would be a consolidation to buy if I were a trader. Consumer discretionary, looking very good in terms of the trend. Materials, also looking very good from a trend perspective. Energy, again, coming at last year, very nice move for energy, some downward move here. Again, a very volatile place to be, and it's going to be going forward. I wouldn't be at all surprised to see it trade down to the 200-day moving average and maybe bounce violently to the upside off of that. That, as I've shown you many times, can be very key support for a sector and for the market overall. Commodities, very good looking chart for commodities in general. Industrials, good looking chart, but you can see, like financials, huge spike. Now we're getting some consolidation. That would be a consolidation I would buy. Consumer staples underperforming, actually coming down since the election, coming back up some this year. This is a constructive look for the 50-day moving average. Looks like it's finding some resistance against the 200-day. Utilities breaking down, but then coming back and consolidating. I'm not bullish on utilities this year on a relative basis. Healthcare, as I mentioned, is coming back up. This is a constructive looking 50-day moving average. Piercing above the 200-day is also a good thing for this particular sector. That'll be something interesting to watch going forward. Looking at bonds, really rough looking chart for bonds. This is about as bearish as it gets. If the economy is indeed getting better and interest rates are going up, quality bonds like treasuries, which this index tracks, are something to avoid. Europe, Australia, Australasia, and the Far East Index, as you know, something I'm very constructive on. The green line piercing above or moving above the blue is bullish, and the trajectory is good so far this year. Emerging markets, similar looking chart, getting better. Europe, Eurozone itself, that's a constructive look right there. Eurozone has some issues going forward, particularly with the coming French election, so we'll see how that goes. Australia, a very commodity-oriented country in terms of the market, very dependent on growth in China and so forth. So this is a good look for the global economy as well as for the Australian markets. The Japanese market finally getting a little inflation in Japan. That's been something that people have bought so far this year. Good looking trend with the moving averages. And India. I'm constructive on India, as many of you know. Demographics are very favorable. The prospects in terms of what the new president is trying to accomplish in terms of unleashing the economy from both a regulatory and corruption standpoint going forward. So I think India is going to be a good story for quite some time, but a very volatile story. The relative performance of Europe, Australia, Asia, and the Far East, that index versus the S&P, getting a little better so far this year after a long stretch of underperformance. Same thing to be said about emerging markets. And then let's take a look at the ratio between stocks and bonds. When this goes up, stocks are doing better. These moving averages, I ran very short ones, 16, 18, 20, 22, and 24 exponential moving averages. This is something Chris Shivako does. He's the technical analyst who I have a great deal of respect for, and I use a lot of his work, so I basically am mirroring some of the stuff he does here. This tells us that the trend is very much intact for stocks to continue outperforming bonds going forward. Gold relative to stocks is underperforming, have a nice rally in gold. I've had some people ask me, is this a trend that will continue? The moving averages say no, it's not, and it would be something to fade, but that remains to be seen. High beta stocks. There's an ETF that just tracks the most volatile stocks in the S&P. This tells us that the probabilities are pointing to that continuing, meaning the higher risk, more cyclical stocks doing better than the overall market. What about the defensive low risk stocks? They're dramatically underperforming the overall market this year, and the moving averages would tell us that that's something to continue to expect going forward. A couple of recession indicators just to finish up with. This is the high yield credit spread, the difference between the yield on junk bonds and the 10-year treasury. When it goes up, we need to worry about the strength in the economy. It says something somewhat ominous about credit conditions out there. Here's the last three recessions. You see the high yield credit spread going up, recession, going up, recession, going up, recession. The last couple of years, towards the end of 2015, I did a lot of presentations on this and talked about what it meant in terms of the state of the economy. One thing that was unique about this spike is that it was very dominated by the energy sector. The energy sector has been the biggest issuer of high yield debt over the last 5 years. And when oil prices declined from $100 a barrel down to 28, those marginal producers had huge problems. There were a number of defaults, and of course high yield investors got very worried and demanded much higher returns from that high risk debt. When you took energy out of the mix, it wasn't so ominous, and here you can see as energy has calmed down, so has this indicator, and it's not giving us any worry whatsoever about a potential recession in the foreseeable future. My favorite recession indicator is the yield curve, the difference between the 10-year and the 2-year treasury. When the 10-year yield drops below the 2-year, it inverts, comes below the zero line, and we almost never get a recession without the yield curve inverting first. Here's the last 5 recessions: inversion, recession, inversion, recession, inversion, recession, inversion, recession, inversion, recession. Nowhere near inversion, therefore we should not be worrying about recession anytime soon based on this indicator. So folks, I'm going to leave it there for now. Look for my weekly message in the next 2 or 3 days. And I'll talk to you again next week. Thanks as always for watching and listening. Bye-bye.